Hi, this is Dak Hartsock. I'm Chief Market Strategist with ACI Wealth Advisors and Process Portfolios. And what we've got here today is a hopefully relatively quick update on our market income portfolio for June 2015 and also year to date. And for those of you that maybe don't know me or don't know who I am or anything much about my firm, you can stop by dakhartsock.com, spelled just the same way you see it right here. And if you'd like to learn more about me, there's a page that says About, and it will give you a little bit about my background, and there's a short video there that might be useful for some of you to watch. But essentially, I'm a nationally cited investment expert and financial educator, and I manage a set of portfolios through ACI Wealth Advisors and Process Portfolios that have both higher net individual investors and also some institutional investors, other managers that like to hire people to manage money on their behalf. So this is just an update on how we've done so far, so let's get right into it. For those of you that don't know, market income basically invests in a basket of highly liquid index or sector securities, generally in the form of ETFs. And we use the ETFs because they have a very high level of liquidity, and that's very important because that kind of means you always have a buyer, if you want to sell something, or a seller if you want to buy something, and that's very important when you're investing money. And what we do is sell off an atypical return in exchange for a premium on a rolling basis. So what that means is, the market typically returns a certain percent per year. And anything above that, we just sell that off because the thought is we would rather have some return, the bird in hand, than the possibility of no return or a lower return or whatever. We're not trying to chase the market with here. We just want to seek some consistent returns with lower than market risk. And what this strategy does is generally, it outperforms in bear markets. It outperforms in neutral markets like we've seen so far this year. It generally outperforms mild or moderate bull markets. But when you get the big run-ups that we saw, over the last few years, a couple of times, like the 26% year the S&P had, it's not going to keep up with that. But what it is designed to do is damp down the volatility of returns, which is another word for risk, and create income and allow you to participate in some of the upside of the market. And if you're the kind of person or kind of investor that is always chasing the market year in and year out, and determined that the only way to measure investment success is if you get every single percentage that the market gives each year, this is not the strategy for you. I'd comment further on that, but the best thing to say is if that's you and you're hiring and firing managers or mutual funds based on that, you need to pick up some books or get a little more education, because you're going to crater your portfolio sometime soon when the next bear market hits. So just be aware that there's risk in behaving like that. So anyway, here's the market income for June. A quick explanation here. What's what? The purple line here up top is the market income portfolio, and this is the performance. Up here we've got positive 1%, down here negative 1%, and so on. And then the green line is the S&P 500, which is an all-stock portfolio. I'm sorry, the blue line is the S&P 500, which is equivalent for an all-stock portfolio. And then the green line is the hedge fund global multi-strategy index, and this kind of shows what the hedge funds across the industry are doing on average. And then the last gold line that we see running from here over to here is a blended or balanced portfolio that is 60% stock, 40% bond. It's kind of the traditional balanced type portfolio that most advisors insist that you need to have. And so what we're seeing is, in the month of June, market income came down about 1.5%, the S&P about 2%, the hedge fund guys a little bit less than market income at 1.3, 1.4, and then the blended stock and bond came down about 1.42. Now, BXM down here is the tracking index for what's called the CBOE buy right index, and you can't actually invest directly in the index, but it basically does exactly what the market income is designed to do. So the two are equivalent, and I wanted to give this number so that you've got an idea of what the real benchmark for this is supposed to be, but you can't invest directly in it. So at any rate, let's look ahead at the full year. And again, the color codes are the same. The purple is the market income. The blue is the S&P 500. The gold is the blended portfolio. And then the green line is the hedge fund guys. And these are all kind of different things you could do with your money, or that we could do with client money. So I just thought it'd be a good comparison to stick it up there, when you're thinking about how money should be invested. And what you see here year to date is the market income is about 3.24% through the end of June, and we see the buy right index is right about in that same area. So we're sticking pretty close to the benchmark. We were above the benchmark a couple of months ago. So when you get differences that aren't too big, that can come and go in any given month. So based on this number, we're doing basically exactly what we ought to be doing. And as you can see here, beginning in about April, when the market started to jump around a lot, this portfolio just kind of motored along. And that's really what it's designed to do, is over time just kind of protect the downside a little bit more than you would get by investing in the S&P, or maybe even in a blended portfolio, but also participate in the upside when the opportunities are there. And you can see that's kind of what it's done so far year to date. So these are all pretty good outcomes. We got about 3 times the performance of the S&P for the year so far. More than that against the hedge fund guys. If you're looking at the traditional blended stock and bond portfolio, again, more than 3 times that performance. So those are all good numbers, nice outcomes to have. And particularly when we look at some of the risks involved in each of these different ways you can invest your money. So the S&P and market income are both all stock portfolios. So what you see is peak to valley. I'm going to point a couple of these out and kind of walk through them so you know what they are. The peak to valley recovery, that means how long it took when a particular index sold down at the most it had sold down for the year, how long it took to get back to break even. And as you can see, we're doing fine. It's happening more rapidly with this particular portfolio than some of the other things you could do with your money. Sharpe ratio is risk efficiency. The higher this number is, the more risk efficient your portfolio is. And as you can see here, we're leading by a very wide margin. Sortino ratio, same thing. You want to look for higher numbers here, and the higher that number is, the better you're doing. And as you can see, again, it's significantly more, a significantly higher number than these, which are actually all negative. Another way to think of Sortino ratio is risk of loss. So standard deviation is risk. It's just a pure risk calculation. This is one of the numbers you want to see much lower if possible. And again, what you're seeing is we're kind of splitting the difference between a blended portfolio and an all stock portfolio. So again, here's the notion of getting kind of equity type performance, or at least consistent performance with less risk than equities. Downside deviation, that just means when the market sells off, what the portfolio has a tendency to sell off along with it. And again, we're kind of splitting the difference here between a blended portfolio and an all stock portfolio. So there again is an illustration of how you've got an all stock portfolio in the market income, but it's taking on substantially less risk than an all stock portfolio anywhere else, and it's doing so in an extremely risk efficient manner, which you can see right here. So positive negative periods, that's just basically the days where the portfolio went up and the days when it went down, and that's kind of an interesting measurement. And again, you can see that we've got a pretty substantial lead over some of the other things that we could put money in, or that you could put money in. So quick summary strategy, or strategy summary. Basically what market income is designed to do is give above market returns in everything except a very strong bull market, but do so with less than market risk. So sort of the way we think about it is more income than bonds, less risk than stocks. And it's again designed to outperform in a moderate bull market, a neutral market, bear markets. It's going to lag a strong bull market. If the S&P throws down to 26% year, this portfolio is going to be left in the dust. But it depends on what you're trying to do with your money. If you want to take risks, that means also a risk of loss. And one of the things we're trying to do with this is be defensive minded, with the way money is invested. So quick forecast, we have this thing called the recession probability indicator. And what that does is it allows us to have an idea of when we may be facing a recessionary bear market, which is terribly dangerous for investments. And at this point, we're getting stable numbers out of that indicator. So the climate is still good for continued investment, despite some of the headlines about Greece and China and so on. hopefully we'll get a more aggressive correction this time around than we've seen in a while. But regardless, that's going to be a buy opportunity at this point. So just kind of maybe keep that in mind. And if you would like some updates on what we think is happening with the broader economy and what the recession risk is at any given time, you again can stop by Hartsock.com and just sign up for the newsletter, because I release the recession update about once a month, once every 2 months. So other than that, a couple legal things just need to get out of the way real quick. Again, you can invest directly in the CBOE Buy Right Index. It's just a tracking index, and that's why I couldn't show the risk analytics for that, because they're not there. And this report is not a model. This is based on consolidated accounts of all the clients whose money ACI and Process Portfolio manages, and these are legitimate live results, and they include fees. So you're going to have some difference in individual account performance, because maybe somebody came into the portfolio in March, or maybe they came in June, right? Or maybe they've been in for a year or more, in which case it could be doing substantially more for them. But the point is this is in general how the portfolio does. If you put everybody together, regardless of when the money came in or when the accounts came in, this is what's going on. And over time, individual accounts are going to come closer and closer to the performance, the consolidated performance of the portfolio. So that's it. I hope this was useful for you, and that you found it a good use of 10 or 12 minutes. And if you've got any questions or you'd like some additional detail, you can just pop by the site and use the contact page, or you could email me at dhartsock@aciwealth.com. And thanks very much. See you next month.